What's up everybody, Nate here, and inflation just slowed at its fastest pace in nearly 2 years. The latest CPI numbers for May are out, and it actually showed that inflation decreased from around 4.9% in April all the way down to 4% in May. Inflation has been decreasing for several months now, and that is leading a lot of people to ask, is inflation finally going away? So today I want to go over that exact question, and I want to kind of show how inflation decreasing is going to affect our economy in 2023 and what we can expect to see next from the Federal Reserve and jobs and consumers. So with inflation coming down in the United States, that means that the general prices for goods and services are starting to come down as well. So in a nutshell, things don't cost as much as they did in previous months. However, one thing that you need to keep in mind here is this is the consumer price index numbers. The CPI numbers come out every single month and they show us how many things are going up in price and how things are going down in price. But generally, there was still a lot of things that actually went up in price last month. Just reading this chart from CNBC, we can see that there is a lot of things that have generally gone up in price over the last year or so. Things that have to do with cars, both repairs and insurance. We're talking about food here, human food and pet food, medical equipment. There's even some recreational things on here like outdoor equipment and supplies, baby food and formula, which trust me, I can tell you that is super expensive right now. And the big one, rent is up too. It's up just a little over 8% on an annual basis. But like I said before, there is also a bunch of things that have gone down. Energy prices, gas prices in general, we're talking used vehicle prices, all of these things have gone down, and these are staples of our economy, and that is really helping out the consumer right now because it gives their money a lot more buying power. Now, inflation hitting an annual rate of around 4% sounds really good, but we have to kind of keep this number in perspective because 4% is still way highly elevated than what we're used to seeing, and it means that prices in general are still going up, and it means things like wages have to continue to go up in order to meet what inflation is. But if we kind of switch gears here and talk specifically about the consumer, well, now the consumer is going to have a lot more buying power to buy a variety of different things because inflation isn't as high anymore, which means the value of those dollars isn't decreasing as quickly as it was, say, in 2022, where we had inflation of nearly 9%. Federal Reserve of New York actually just put out a really interesting survey about consumers and what they expect inflation is going to look like over the next year or so, and the median range for the consumers in that survey was around 2.5% to 3%, and most consumers believe inflation is going to stay at this 4% mark for pretty much the entire rest of this year or go slightly below that. Now, what we can kind of get from that information is consumers have a lot more confidence in their spending right now, so that means that there's a chance that they could go out and spend a lot more money in 2023. There's also been some other surveys that have been conducted by the Federal Reserve and the federal government and some independent agencies that show that the vast majority of Americans right now feel like they are in a good place financially. Around 75% of Americans feel like they are in a good financial standing, so that means they feel like they have enough money to pay for their bills and they have a little bit extra to do whatever they want. The interesting part of that, though, is there is still a small portion of Americans that do believe that our economy isn't heading in the right way and that they're worried that inflation could go back up again. Businesses feel the exact same way, and this is the really interesting part of inflation because when we talk about prices and inflation going up, what it ultimately comes down to is expectations. Businesses have to know in advance, though, where that demand is going to be so that way they can create products in enough supply in order to meet that demand. So if they believe like inflation is going to continue to go up and consumers are not going to be buying as many things, well, that might mean businesses have a scarcity with a lot of their products, so they're not going to make as much. But if we actually see the opposite happen and now consumer expectations dictate that inflation is going to continue to go down and businesses feel like inflation is going down too, well, that means they might produce a whole lot of products so that way they could sell a lot more. But if there is one thing that you take away from this entire inflation report, it is how the Federal Reserve is going to react to the news. The Federal Reserve is in charge of a lot of the monetary policy of the United States, and lately they have been stirring up some trouble with our economy with their interest rates. Basically, the Federal Reserve in the United States is in charge of how much money actually gets printed. Now, the Federal Reserve doesn't actually print the money themselves. They are an independent body that essentially will tell the Treasury Department how much money needs to be printed. So what that means is the Federal Reserve has a direct influence over the Treasury Department and how much money actually gets borrowed and spent in the United States. The way that the Federal Reserve kind of controls that is with its interest rate policies. This is its number one tool in controlling inflation and controlling the monetary supply CPI of the United States. When interest rates are really low, well, that means there is a ton of spending going on. It means that businesses and consumers have a really easy time accessing money. They can go out and borrow money really easily because interest rates are very low and they can pay that money back very quickly. This is part of the reason why you saw pretty much everything in our economy go up over the last couple of years. People were going out and getting mortgages because interest rates were near 0%. Same with auto loans. People were getting personal loans. People were borrowing money like crazy. Investors on Wall Street and even in the private markets were borrowing money like crazy because they could get a huge return on a 0% interest rate for their loan. Businesses also took on a ton of debt. They took on a lot of loans so that way they could expand as fast as possible. So that meant that there was a lot of spending, everything got inflated, and of course, we also saw a lot of inflation in our economy. But the Federal Reserve also has the power to do the opposite, right? So they can actually raise their interest rates and sort of restrict an economy and restrict spending all at once. When interest rates are really high, well, that's going to mean that people can't qualify for a mortgage, or they have to qualify for a much smaller mortgage, meaning their purchasing power is a whole lot smaller. Same with auto loans, same for investors on Wall Street. Investors don't want to take a huge risk on their money at a really high interest rate because paying that money back is going to be a lot harder and they're not going to be able to get as big of a return on their money. And if they don't get as big or a bigger return on their money, well, now they're barely breaking even and there was really no point in investing in the first place. So again, what that does is sort of negate a lot of that spending. Investors don't want to get into it. Consumers can't simply afford it. And when you have demand coming down in your economy, that means inflation is also coming down too. People don't have as much money to go out and spend. And that is exactly what the Federal Reserve is working on right now. The Fed has raised its interest rates 10 times since about March of 2022. And now interest rates sit a little over 5% in the United States. But like I said before, with this news, how exactly are they going to react to it? We don't actually have that information as of yet. The Federal Reserve has said repeatedly that they're going to look at the numbers and then decide what they're going to do with their interest rate policies. But if you look at what the stock market is doing, well, the stock market is currently pricing in a 93% chance that the Fed actually pauses its interest rates altogether, meaning interest rates are not going to go higher. The next step for the Federal Reserve would actually be lowering their interest rates. So right now they might keep their interest rates at around 5% and see if that is enough to keep inflation going down. If it's not enough, then they might continue to raise their interest rates, or if it's too much, they'll actually start cutting them. Now, what you need to know here is if the Federal Reserve actually pauses its interest rate hikes and keeps interest rates right where they're at, well, not really much is going to change in our economy. Things might stabilize a little bit, and that is exactly what the Federal Reserve wants. They want demand to sort of fall so that way supply has enough time to sort of meet where demand should be. And it'll allow interest rates for, say, like mortgages to kind of settle down too. Mortgage interest rates have gone crazy over the last few months because they don't really know where the Federal Reserve is going to go next. Some weeks interest rates might be a lot lower, say like in the 4 or 5% range, and other weeks they might be in the 6 to 7% range. It really just depends on what they think the Federal Reserve is going to do. The Fed also has to keep that in perspective too. They have to keep those expectations in perspective because if they come out and say that they are pausing their interest rates and they're potentially going to cut them, well, that could lead a lot of overspending because now confidence is going to shoot up because everybody thinks that our economy is going in the right direction. But if Americans and investors start piling in on cash all at once, that could again make inflation go up really fast. So they have to manage those expectations. And again, if they do the opposite and they say things are really bad in our economy and they're going to raise interest rates a lot more in the future, well, that might scare off a lot of people into thinking that our economy has a lot of problems and scare off investors from investing, and they don't want that either. So they have to have a happy medium, and that is exactly what I think Jerome Powell and the rest of the Fed are going to announce tomorrow. There's going to be a happy medium. You're not going to get as much information as you'd like. The last thing here I want to talk about is jobs, because when we talk about the Federal Reserve and how they sort of manage inflation and monetary policy, there are two major things that they look at. The first thing that the Federal Reserve looks at is prices, and in general, prices have been coming down, but the second thing they look at is the jobs market. When we talk about the jobs market and the Federal Reserve, they actually look at one really key indicator, and that is something known as maximum employment. In their eyes, there is a maximum amount of people that can be employed in the United States at one time, and they actually believe that there is too many people employed right now. Well, what exactly do they base that on? Well, the Federal Reserve looks at inflation numbers, and with a lot of people employed and getting pay raises, they believe that people people are buying too many things. There's way too much demand because there's way too many people employed who are making a lot more money. And the Fed has actually been talking to businesses about this for a while. Like in 2022, they released an entire report how they wanted businesses to completely freeze hiring altogether. And I think one of the major reasons for this is because at the time we were facing the Great Resignation, where we had millions of Americans sort of moving from one job to the next, but we also had a period of really high inflation and really low interest rates. That meant that Americans were moving to new jobs and they were getting these huge pay raises. That was sort of one of the biggest incentives for them moving, and they got really big benefits. Now, these are things that greatly benefit the American worker, but at the end of the day, if this happens across the entire board, well, that means that people are going to be spending a lot more money, and spending a lot more money can lead to higher inflation. But like I said, they wanted businesses to freeze their hiring because they knew people were getting hired at really high incomes, and they knew that there was way too many people getting hired all at once. Now, in businesses' defense here, they wanted to hire a lot of people because we were coming off of the pandemic and there wasn't a lot of things getting made, and people had a lot of stimulus money and people were getting raises, so there was a lot of demand, but businesses couldn't keep up with the demand, so they needed to hire people in order to produce more. But now we have started to see layoff after layoff because interest rates have been really high. Basically, businesses are not able to get consumers money right now because people don't want to spend as much money because inflation is so high. Everything costs so much that they're only buying what they need, and when it comes to what they want, they're picking and choosing. And then the other way businesses can make money beyond that is through investor liquidity. So investors will put money into the stock market, or private companies will raise money, but they're really not able to do that because, again, borrowing costs are really high. The Federal Reserve actually wants that though because they want to raise unemployment in the United States. Senator Elizabeth Warren actually questioned the chairman of the Federal Reserve, Jerome Powell, on this exact issue during a Senate hearing just a few weeks ago. She asked him if raising interest rates and their monetary policy is going to cause unemployment, and basically the Fed said yes. Estimates show that if the Federal Reserve continues to raise interest rates, well, that could mean 3 to 5 million people end up losing their jobs. Obviously, that's going to create a lot of disparity in our economy, and that's going to mean that a lot of people are out of work, and the Federal Reserve knows this. But what you also have to keep in mind here is the Federal Reserve is doing this on purpose. But it's not because they're a bad agency and they want to see people employed, it's because their duty is to protect the US dollar. The Federal Reserve wants to make sure that inflation stays as low as possible because it's the reserve currency of the world, and for it to continue to have value, that means people need to continue to invest in it and buy things with it. But if it's continuing to lose value, well, that means other countries are not going to want to take on United States debt, which means the US doesn't grow as quickly. And it means that a lot of other countries are going to go towards other currencies. And we have already seen this with China actually offloading a lot of US debt because of our inflation issues here at home. So they have a lot of those issues to work with. And again, I'm not sitting here saying that this is a great move by the Federal Reserve or a bad move. I'm just kind of giving you the facts. All in all here, is inflation going away? Well, like I said at the beginning of this video, inflation is currently at 4% in the United States, and that is still elevated from where it should be. The Federal Reserve likes to keep it at around 2% every year because they like to print money. They like to have people borrow money because that grows our economy, but they don't want too much of that happening because now everything gets sort of thrown out of whack. But just like inflation went up really quickly and then down really quickly, it also has the potential to go back up really fast. If you see the Federal Reserve pause their interest rates or cut their interest rates altogether, well, then that means there's going to be a lot more spending going on in our economy. It's going to be easier for people to borrow money. It's going to be easier for investors to spend money too. That could eventually mean prices go right back up, and now you're in the same exact situation. So the Federal Reserve has to be very careful with what they do with their interest rates. There's a lot of other factors that affect inflation as well. You have geopolitical issues. You have a lot of problems that happen across the entire world that affect prices here at home. And the fact of the matter is the Federal Reserve and the United States government can't really control those things. So as long as those things still exist, as long as you have supply chain issues, you're always going to have inflation. And like I said before, the Fed likes to keep inflation at around 2%. So no matter what, you're always going to have inflation in your economy. So the bottom line here is inflation isn't really going away. It might might continue to go down, and it's something that you as a consumer or you as an investor always have to keep in mind. That is exactly why financial education is so important, so you can see these inflation numbers and sort of take the entire grand scheme of our economy in account when you're making decisions with your money. I don't have a crystal ball in front of me. I can't tell you exactly what is going to happen next with the Federal Reserve or inflation, but all I can tell you is you have to know what to do with your money. Let me know in the comments below what you think is going to happen next with inflation. Do you think it's going to continue to go down, or do you think this is just a fluke and inflation is ultimately going to go right back up? If you want to stay up to date with me and everything else that's going on in the business and financial world, I've got another video ready for you right there, so be sure to check that out before you go. That is it for me, everybody. Be kind out there, and I'll see you all in the next one.